Ladies and gentlemen, good day and welcome to the Q4 FY22 earnings conference call of Aarti Drugs Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Adish Patil, Chief Financial Officer. Thank you, and over to you, sir.
Good evening, everyone, and thank you for joining us today to discuss our financial results for the quarter and financial year ended March 31st, 2022. Before I take you through the performance highlights, let me remind you that as communicated in the earlier earnings call, the financial performance on a year-on-year basis is not exactly stable, especially in terms of realizations and margins, because of elevated API margins driven by sudden supply disruptions due to COVID-19 related lockdown during the financial year 2021. The company reported resilient set of performance with improved product mix, even though the entire globe continued to face unparalleled challenges in the business environment. I will now take you through segment-wise performance. First, we will discuss standalone business performance. Revenues for quarter 4 FY22 stood at rupees 642.1 crores as against 452.9 crores, a healthy growth of 42% year-on-year. Standalone business contributed approximately 90% to the consolidated revenue. Approximately 61% of the revenue came from the domestic market, while the remaining 39% came from the export market for Q4 FY22 for a standalone business. Domestic revenue grew approximately by 37%, while exports grew by around 50% year-on-year for Q4 FY22. API volume grew considerably by around 23%, led by healthy growth in chronic therapies, especially in anti-diabetic segment. Within the API segment, the antibiotic therapeutic category contributed around 43%, anti-diabetic around 17%, anti-protozoal around 14%, anti-inflammatory around 12%, antifungal around 9%, and the rest contributed around 4% to the total API sales of Q4 FY22. Going forward, the growth in chronic therapies is expected to outpace the growth in acute therapies, mainly driven by recently commissioned anti-diabetic capacity. Formulation segment performance. For the quarter, the revenue for formulation stood at rupees 69 crores, growth of approximately 10% year-on-year. Formulation segment contributed around 10% to the consolidated revenue for the quarter. About 39% of the formulation revenue came from exports during the quarter. Exports continues to be a key focus area for the formulation. Now we'll discuss specialty chemicals and intermediate segment performance. For the quarter, revenue from operations for specialty chemicals and intermediate stood at rupees 56 crores, which grew 17% on a year-on-year basis. For the FY22, the revenue from operations stood at rupees 210.8 crores, a growth of 28% year-on-year basis. Company's strong chemistry skills along with a niche presence in chlorosulfonation products led to this healthy growth. The growth trajectory for this business is expected to continue further, driven by recently commissioned brownfield expansion at Tarapur facility. On a consolidated basis, company's FY22 revenue stood at 2,500 crores, a growth of 16% year-on-year basis. Also, the company posted robust revenue growth of 39% in Q4 FY22, which was primarily a 46% year-on-year growth in API business, along with 17% in specialty chemicals, intermediate and others. EBITDA and PAT grew by 9 and 7% respectively. EBITDA margins were affected due to continuous up in raw material prices and power and fuel cost, especially the coal cost. The company's overall product mix, especially in API products, improved considerably, along with improved operating leverage, which helped the company to partially offset the impact of higher raw materials. However, multiple headwinds such as ongoing Russia-Ukraine conflict, continuous inflation in the input cost, especially solvents which are related to the crude price, supply chain disruption, recent China lockdowns due to spike in COVID-19 cases, etc., had an impact on margins and profitability in Q4, as well as for the entire FY22. The company is closely monitoring the evolving geopolitical events. The company has undertaken multiple price hikes during the quarter, partially offset the impact. However, these price hikes were not sufficient as the velocity and volatility of increase in input costs due to the reasons just mentioned remained very high. The company expects stabilization in the margins once the input prices stabilize, which we expect by the end of Q2 FY23. The company is also focusing to increase the revenue contribution from therapies, especially from anti-diabetic products, antifungal products, which would help the company to regain the sustainable long-term EBITDA margin levels. Coming to the important update, in the USFDA inspection for Tarapur import facility, the company has successfully completed the third-party mock audit recently. The audit was carried out by the USFDA consultants who are the ex-USFDA inspectors themselves. The final response will be submitted to the USFDA towards the end of H1 FY23, most probably by the beginning of August month. And the USFDA inspection is expected to be done by the end of this financial year. The company remains confident of the positive outcome. Apart from this, the same facility has cleared Australian TGA inspection audit recently, which will enable the company to expand the business further in Australia as well. The company incurred a capex of rupees 145 crores during the year. The company's plan to further invest rupees 250 to 350 crores in FY23. After witnessing sluggish construction activity in H1 FY22 owing to prolonged monsoon, the pace has picked up in H2 FY22. For the Gujarat project, the civil construction activity has picked up the momentum, which is expected to operationalize towards the end of current financial year. Expansion for Tarapur brownfield specialty chemical has come in successfully. Scale-up batches have been undertaken since the start of the current month. For Tarapur greenfield API facility, boiler and zero liquid discharge treatment plants would be operational by this month end, and the company is planning to scale up the production by the end of FY23. Net debt to equity as of March 31st, 2022 stood comfortably at 0.52 times. The working capital cycle, however, got elongated as the company strategically increased the raw material inventory owing to high inflationary nature in the raw material and probable disruptions in the supply chain. There is some increase in the finished good inventory as well due to anticipated pickup from the customer in Q1 FY23. As a company policy of rewarding shareholders, the company has paid 81 crores in FY22 in the form of dividend and share buyback. The company remains committed to create the value for the shareholders by enhancing the strategic value proposition through capacity augmentation, cost rationalization, backward integration, strong focus on R&D, and optimal capital allocation. With this, we can now begin the question and answer session. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ankush Mahajan from Axis Securities. Please go ahead.
Hello. Sir, I just want to understand the capex. Now, last year our capex is 145 crore. Can I get the breakup of this capex for in terms of the therapies? And what is the another capex that we are looking for next year?
The main projects which are going on, one is already has been started. The brownfield expansion of a chlorosulfonation facility at Tarapur. We just commenced with that project in the month of May. Then there are two main greenfield projects which are going on. One is going on in Gujarat, that is for the backward integration and intermediate space. The Tarapur greenfield project is focusing on dermatology related API. So both these projects will by the end, but mostly by the end of current financial year, and that is where the majority of the capex will be going. And a very small portion, say 40 to 50 crores of the capex, will be utilized for general brownfield expansion facility, the GMP enhancement, and some bit for the maintenance capex.
So we can say this year 250 to 350 crore capex. It will go for this brownfield expansion and other expansions.
Apart from that, say 40 to 50 crores of brownfield and maintenance capex. Apart from that, the major capex is for the same projects which we have highlighted before, that 500 to 600 crores capex and which we had. So it is going for the same project, mainly for the greenfield project, one at Tarapur and one at Gujarat.
Thank you. So if we see that we already invested 145 crore and we were looking some 5 times turnover on capex, but this year our incremental sales is on the lower part. How do you see the scenario next? And my second question is related to the gross margins, about the raw material prices. How do you see the increase in raw material prices going onwards? I mean to say when we can expect that things could get stable.
Okay. To answer the first question related to capex, the brownfield expansions which we are doing, they are definitely giving that 5 times asset your revenues to asset turnover. But for the greenfield ones, it is somewhere in the region of 2 to 2.5x. And other question regarding the raw material prices, I would like Harit Bhai to answer your question.
It's very difficult to give any guidance on raw material because due to current.
Just try to understand how the things are taking shape and what's your view on it.
It's very difficult to give any view, but looks like inflation is at top, and all the governments are trying to control inflation. So demand may come down overall on commodities, and we expect price to come down by another 3 to 4 months, but not at the original level, but it will come down. Yeah, we expect price to come down.
Thank you. Thank you, sir.
Thank you.
Thank you.
The next question is from the line of Rashmi Sanjay from Dolat Capital. Please go ahead.
Yeah, thank you for the opportunity and good evening to everyone. Adish, one question again on gross margin front. With this kind of pressure, can we believe that, our operating margin can be sustained at around 12%? Or you believe that there is a scope of improvement with the brownfield capacity coming in place? With the better product mix.
Okay. Are you asking for the first quarter of coming financial year or?
No, so the quarter 4, I think we reported around 12% operating margin. So I'm asking regarding that is this kind of margin will be able to sustain? Because I think you all mentioned that till another 2 quarters there is a likelihood of seeing high raw material prices pressure. So are we going to sustain this, or there is a scope of improvement in the overall operating margin?
Understood. For the next 2 quarters.
Yeah.
API, the standalone margins were, EBITDA margins were around 13.2 for March quarter. We believe that at overheads level also we can easily improve around 0.5 to 1%. But apart from that, at the gross margin level, definitely the current commissioning of chlorosulfonation plant, brownfield expansion, that segment is more profitable for us. So the product mix would be favorable in terms of betterment of the gross contribution for the first quarter. Definitely it will help more in the second quarter because the production has just started. And as far as the price hikes are concerned, so we were doing the analysis, means in the March quarter, if we see, we definitely have taken price hikes. About 85% of our products have maximum prices in the March quarter if you compare all the 4 quarters of last year. And even in the March quarter itself, if we compare 3 months, January, February, and March, then approximately around 50% of the finished goods were having higher prices in the month of March. So definitely price hikes will also help us regain some of the gross contribution. So, but then because the situation is so dynamic, though it will become better, but then it is not as easy to forecast as of now.
Okay. So I understand there is still uncertainty regarding that. But whatever growth that we have seen in API segment during this quarter, around 45-46%, that is all because of the price hike, or there are new products that is anti-gliptin products and all have been commercialized or have started supplying?
Okay, the gliptin means we launched those products, but they are not yet significantly impacting our turnover as of now. But we expect them to do that in coming future. However, what was your other question?
So basically wanted to understand that all the growth which is coming in the API is mainly because of the price hike only?
Okay. So in the domestic market, we recorded a growth of around 36 to 37% in value terms, out of which 50% of the growth was due to volumes. Whereas in export, where we recorded the growth of around 50% in the last quarter, around 30 or 32% of the growth is because of the volumes, and the rest 18-19% is because of the rate variance.
Okay. Thanks. That's it from my side.
Thank you. The next question is from the line of Rahul Jha from Bay Capital. Please go ahead.
Yeah. Hello.
Yeah.
Hello.
So please proceed with your question.
Yeah.
Yes, we can hear you.
Yeah. So in last year's presentation, you had said that you have around 1,500 plus employees. In this year's presentation, you are saying you have around 1,000 employees. So around 500 employees less. But your employee expenses are higher for the year. So what is the disconnect?
I think there might be some mistake. There might be some mistake in it. We'll get it corrected.
Okay.
We haven't reduced the workforce actually.
Yeah. So, but this year's presentation has around 1,000 employees, so 500 employees less. So
Yeah.
I think
There is some typo error in that. We'll get it corrected. Thank you for pointing out.
Okay. Second, on the the capacity. So you have done some around 150 crores of capex, but your installed capacity has increased by just about 0.5, even less than 1%.
So most of the this capacity was in means capacity as in the cash outflow was in capital WIP. That is the reason why the capacity enhancement was not seen to that extent.
Okay.
But now in the month of May, we have come up with chlorosulfonation capacity, and in the last quarter of this financial year, we will come up with 2 more capacities. So that is the point when you will see the.
Okay. 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 Thank you.
Thank you. The next question is from the line of Ranveer Singh from Sunidhi Securities. Please go ahead.
Yeah, thanks for taking my question. My question relates to that US FDA inspection we are awaiting on Tarapur facility. So if successful, what kind of a scope we can expect from this facility?
So there are a couple of indirect benefits as well, other than the fact that a couple of products, our ANDAs are still active. So for those products, some commercial can be started. Definitely, in the beginning it will be slow, but then it can pick up. But apart from that, there are a lot of indirect benefits in the terms that facility also has EU GMP approval and CEP approvals for a few of the big products which we manufacture and we are pretty strong in. So there is a lot of demand of those products in the European market, but because of this import alert, the cracking that market has been little difficult. So if import alert is cleared, even for the European market from that facility, we can achieve a lot of growth.
Can you highlight the number of products currently we can readily start supplying for US or Europe?
So there are 2. Yeah, for Europe. Okay. For Europe, we have products like we have 3 good products like ciprofloxacin, celecoxib, and clopidogrel from that facility. There are other products as well like zolpidem tartrate, which are doing quite well for us.
So this is for Europe or US or?
Same products we'll be doing for US as well.
And earlier when import alert came, that time there was 2 facilities and one of the facility was already delisted with the US FDA as per your press release, and one facility had got import alert. So that the another facility, what is the status of that facility? Whether we got it again listed?
Okay. So that facility was never intended to be a US FDA facility, which got inspected at that point of time. So that was the reason why we delisted that facility. However, that is a very big and important facility for us for rest of the market, which includes Latin America as well. But going forward, we are planning to get a EU GMP certification for that facility. But that facility is never intended for the US market. So there are no plans to convert that facility into US FDA. But for Europe, we do have plans.
Okay, thanks. And for this year, we have a capex of 145 crores. You mentioned some projects, but I think some of these projects are not complete. So for up to FY22, that 145 crore, on what projects actually we have spent it?
So that went in. So we had done a lot of debottlenecking. We spent in that and couple of greenfield projects. So that money is still lying under capital WIP. And there was one big brownfield expansion for chlorosulfonation, which was also going on as of 31st March. But that project has now been completed. So it will be put to use in the month of May.
Okay, so just help me understand.
The major was in the greenfield.
Okay, so one was the intermediate project, which was under PLI scheme. So is that project is complete?
So that particular project, we opted to not go for PLI, but we still have expanded the capacity for that particular product. The reason we did that was because at the time when we applied for PLI, there was a commitment of some around 70 to 80 crores for implementing that project. But then due to advancement in the technology, we were able to complete that project at a very, very nominal cost, So that is the reason we had requested government that we will implement the same project, same capacity at a lower cost. But then they said that no, you will have to meet that capex requirement, which we thought that unnecessary spending money upfront, there is no point, and then apply for the PLI scheme. So that is the reason why we opted to go for that capex without PLI, and we have already first stage of expansion for that particular product has already been done.
Okay, and so what is the capex on that? 70, 80 crore, isn't it?
Yeah, it will be less than that, correct.
And other products like gliptin related products we have, then skin treatment related API, chlorosulfonation you mentioned.
So that capacity we have implemented, and it is already online.
Fine. That's it for myself.
Thank you. The next question is from the line of Aejas Lakhani from Unifi Capital. Please go ahead.
Yeah, hi, am I audible?
Yes, sir, you're audible. Please proceed.
Yeah, okay. So could you just repeat the amount you spent for the capex on the PLI? I couldn't catch that number you mentioned. What was the capex?
No, it was less. I said it was 20 crores.
Sorry, sir, 20 crores. Is that what you said?
No, much less than that. Means we are not giving out the exact number.
Okay.
It was much less than that.
Okay, got it. So my questions are the follows. The first is, could you give the broad gross margin guidance or a range for the APIs, for the spec chem and intermediate, and for the formulation for Aarti Drugs as a company?
So the thing is, guidance is for a long term, definitely for APIs we would like to achieve. Right now we have a composite gross margin for API and specialty chemicals.
Yes, sir. I'm just asking that.
It was around.
No, sir, I'm sorry to interrupt, but I'm just asking that broadly, the API basket, what is the broad gross margins that you have? What is the broad gross margins on formulation and spec chem and intermediate? The reason I ask this is so that we get a sense of how your gross margins may move in the future.
So the spec chem is the maximum, but then again, since you're asking only for the gross margins, spec chem will be much higher, means almost, in some cases it will be as high as 50% as well. But these are higher in those particular products. As far as APIs are concerned, on a aggregate level, I would say it should be somewhere in mid 30s to late 30s, the targeted gross contribution. Whereas in formulation, it is slightly lower. Vishwa, would you like to answer that?
Yeah, sure. So currently, formulation gross margins would be about 25%, between 25 to 28%, depending on the quarter. And we do see in the coming quarters, in the coming years, an improvement in that because our gross margins are quite lower on the domestic front and substantially higher on exports. So right now we have about 38 to 40% export revenues, which we foresee to grow to a larger number, and that will improve the overall gross margin and take it maybe closer to early 30s.
Got it, sir. That's helpful. So my next question is that you've done a 145 crore capex. You mentioned 5 times asset turns. How much of that should we expect from a capacity utilization in 23?
I would like to clarify one thing, that 4 to 5 times asset turn is for the brownfield expansion, not
Right.
for the entire city.
Yes, you did the 145 crores as a brownfield, right?
No. See, in 145, a lot of money has gone for the greenfield projects as well, which are still in capital WIP.
Okay, so how much of this could you quantify went for the brownfield and for the greenfield?
So, see, very roughly around half of it must have gone for the greenfield, and half would be for maintenance as well as brownfield, and some bit I think went for the land parcel which we procured, I believe.
Fair enough. So, sir, also the other thing is you mentioned that there is more capacities which is coming on stream at the end of FY23. So are you referring to the greenfield capex which is for the intermediates of which you have already spent 70 crores give or take, and the 250 crores which you're going to spend in this year, all of that will come on stream in FY23 end?
So the Tarapur facility will, seems like it will come on stream, say a couple of months or 3 months before the Gujarat facility. So the Tarapur facility, we are hoping that we'll be able to come in the trial production by last quarter of this financial year. However, the Gujarat facility is that by the end of this financial year, we should be able to complete the project. So maybe immediate start of the next financial year, we should be able to start the trial production.
Got it. And so out of the 70 crores that has already been incurred and 250 to 300 that you're incurring this year, how much of that block is towards Tarapur and how much is towards Gujarat in terms of cap?
Coincidentally, the allocation is almost equal for both the greenfield projects. They're both equal.
Got it. And sir, you generated about 70 crores of operating cash flow this year, give or take your run rate, for the coming year. Basis that, given the high amount of capex that you're incurring along with the dividend payouts you're doing, how much will be incremental debt and how will you fund this capex really? If you could give some more color on that.
Yes. So the major reason why the operating cash flow is looking less in this financial year is one of the major reason is the fact that we have done historically highest sale in the last quarter, about 697 crores, and typically our data cycle being somewhere in 90s. So all of that has went and sat in the receivable portion. So that is the reason why suddenly the increase in receivables is more, and that is why the cash flow from operations is looking less. However, what we are foreseeing is that our debt to equity ratio will go as high as 0.7 for the upcoming greenfield projects when we implement that partially through accruals and partially through. But the targeted debt to equity number is around 0.7, and once the projects start giving revenues, then it will again come down.
Got it, so that's helpful. And sir, you had mentioned that you have a contract with an MNC for the specialty or intermediate products. So is my understanding correct that the recently concluded brownfield expansion that you have done, for which you spent about 75 crores as you indicated, is also the capacities that are going to be used for this contract?
A very small portion of that went for debottlenecking or incremental expansion of that product, whereas some other portion also went for a big brownfield expansion for another chlorosulfonation product of ours. So there are two products involved where brownfield expansion happens.
Got it. And so you mentioned the guidance. You mentioned, I think last call, the aspired guidance of EBITDA being around 18%. So do you see that run rate being hit in probably 3Q, 4Q of this year?
So yeah, the problem is that we were hoping that 17-18% EBITDA margins should be sustainable. However, the increase in the input cost is so high, almost we were doing an analysis of FY22 versus FY21, So the rate variance in the raw materials is as high as 25% in terms of the increase in the prices year-on-year basis for the entire year. Because of that, now we are taking hikes at the prices at the selling end. But then the thing is, for many of the products, formulation people, they have a cap at which they can sell their product in the market. Though the cap is increased by 10% or so every year, but nevertheless, the hike in the chemicals and the APIs has been more than that. So definitely, we will face some hit as far as demand is concerned. However, once the price ease off from this level, then everything should be back at normal. So in short, by Q2 or Q3, 18% would be little too optimistic. But first, we will try to achieve that 16% EBITDA margin by Q3, and then from there onwards, with the introduction of this newer product, more intermediates, then probably we can look forward to increase it further.
Got it. And so the newer chronic APIs that you're having, are their gross margins, say 300-400 pips higher than the acute therapy APIs?
It's a good question, but then the thing is, the margins, the situation has been so dynamic, So the margin changes. I mean, usually chronic products had a better margin, but if there is change in market dynamics, as in some of the intermediate of a particular product goes high suddenly, then suddenly in one particular quarter, some other products look more profitable than this product. So it keeps on changing. The situation is very dynamic. But I would say before all these macroeconomic factors hit us, before that, the margins in the chronic segment was, but then with the current scenario, it is all up and down. I mean, sometimes one product looks better, sometimes other product looks better.
Got it. And so competitive intensity in chronic APIs is lower or higher? And who are your key competitors here?
See, there are a lot of Indian in the metformin market. There are almost 6 to or more than around 8 players or so. 6 to 8 players who are operating in metformin. The bigger would be, I would say, 3 or 4, and the rest would be smaller. So we expect that there will be some kind of consolidation in coming couple of years. The smaller players ideally will exit. It will also depend on the fact how fast we scale up the capacities further and how fast the market grows. Because typically what happens that if market is growing at X percentage and the introduction of fresh capacities are more than that, then typically the weaker players start exiting the business. So that is how it will shape up.
Got it, sir. Thanks, Aarti. I'll fall back.
Okay.
Thank you. The next question is from the line of Saravanan from Unifi Capital. Please go ahead.
Yeah, thanks for taking my question. What sort of volume growth are we targeting or expecting to achieve in FY23 as well as FY24 in API segment?
Ideally, we should be targeting about 10%. Last year also we on a entire year basis around 10% volume growth we were able to achieve in FY22, and similar kind of volume growth we hope to achieve in the coming year as well.
Okay, and is this 90 crores per quarter is like a base EBITDA, and we would be able to grow on that. So I'm talking not as a margin term, I'm talking as an absolute EBITDA. Is 90 crores per quarter is a sustainable number?
Yes, 90 crores should be fairly easy in that way.
We request all the participants to please stay connected while we reconnect Mr. Patel. Ladies and gentlemen, we have the line for Mr. Patel reconnected. Thank you, and over to you, sir.
Yeah, Saravanan, I was saying that 90 crores is very much doable, but we hope that it will be more than that.
Okay, that's good to know. And formulations, what is the prognosis there? Would it grow faster than the API segment in the formulation segment in the coming years?
Which would you like to do?
Yeah. So, compared to the API segment,
Mr. Vishwa Savla, so sorry to interrupt, but your voice is not coming clear, sir.
Am I audible now?
Yeah, now it's fine. Yeah, please proceed.
Yeah. So I was saying in the formulation segment as well, we are undergoing a capex expansion for a new oncology plant, as well as which will be commissioned in the coming 3 months. As well as we are also increasing our product portfolio with a good pipeline of products and expanding our market reach in terms of more international markets. So we do foresee to grow at a faster pace in the next 3 years, and the projection is to try and double our revenues in the coming 3 years. So and we are in terms of our resources, we are on track for that.
Got it. And the US FDA plant, currently it is being utilized, right? Although we are under alert, it is getting utilized for other geographies, or you're still waiting for the clearance and then you will use it only for the US business?
No, as of now, it is being utilized for other geographies, but then the utilization is fairly low. And moreover, the that will happen if we sell more to regulated markets. That will be the key factor, for driving growth, profit growth from that particular unit.
Okay, so that's an important lever to look forward to, right? Once the US FDA clearance happens by end of this year, and so your regulated markets would get fast track, which will improve the margin trajectory overall.
Correct. Very true.
Okay, thanks a lot, and all the very best.
Thank you. A reminder to the participants, anyone to ask a question may press star and 1. The next question is from the line of Runjhun Jain from Nirmal Bang. Please go ahead.
Yeah, thank you for the opportunity. Sir, just 2 questions. One, you have said that you have taken the price hike, and most of the price hikes were probably taken during the March. So you believe that the gross margins, what we have witnessed during this Q4, is kind of bottomed out, and we can see quarter-on-quarter improvement on that?
one thing I noticed that in the month of March also, when we were negotiating orders, that time also the margin was low. For the month of April and May, whatever we are negotiating, the margins have slightly improved for a few of the major products of ours. But then for the impact to come, it takes around 2 months. Means probably towards the end, as we exit the first quarter, maybe June month might be better. That is what I have a feeling. But the quarter itself, the Q1, will definitely be impacted. Impacted means more or less similar kind of margins we will observe.
But even what we are saying, sir, have you seen, in fact, in the raw material prices that month on month also there is any increase in that, or that is kind of stabilized right now?
Raw material prices?
Yes, sir.
Raw material prices, we haven't seen a decline yet.
But there is an increase, or there's been stabilized? The question is coming from, sir, because if the raw material prices have stabilized, and whatever improvement you take or hike you take on the finished goods, so that improvement, whatever small, should be visible. So that is what my understanding is, that we should see some improvement in margins, at least for Q1.
Yeah, I will answer a little differently. Means, see, what taking orders means negotiating both the output side and negotiations which are happening in the month of April and better than March. However, these are the orders being taken, but the orders means for exports, our pending order is around 3 months. For domestic, it is somewhere 20 to 30 days. It's something like. And similarly, raw materials for imported, it will be a couple of months. For domestic, it would be 15 to 30 days. So, for that to come into the finance, what I mean.
Okay. So this last question, is it possible for you to give the Q&Q volume increase, either for API or for the whole company?
With respect to December?
Yes, sir. So from March to over December, is there any improvement in the volumes in API?
We will do that. I don't have it yet. But overall, on the entire year basis, the volume growth is 10%.
10%.
FY22.
Okay, and quarter on quarter, I'll take it from your offline, sir.
That I will do, but I will note.
Sure. Thank you so much, sir.
Thank you. Before we take the next question, a reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Ankush Mahajan from Axis Securities. Please go ahead.
So I just try to understand this capex of 250 to 350 crore. Can you give me more breakup for this capex, that this is for which therapies actually we are going to use this capex?
Yeah.
And what is the timeline for this?
The timeline is 1 year.
Okay.
The thing is, if you remove, say, around 40-50 crores apart, then rest of the capex will be equally divided into 2 portions. One will go in Gujarat Greenfield, and other will go in Maharashtra Greenfield facility equally.
Okay.
And will be coming up with the backward integration and a few other intermediates. So there will be specialty chemicals intermediates kind of a thing, and some bit of it will be using captively as well. Whereas the Tarapur Greenfield would be more of the API and allied and few derivatives of the APIs.
So what are the? Can you give us the name of the therapies?
The therapy would be it goes in derma segment. in the skin treatment, skin care.
For the API. And for the specialty API, specialty products,
So that could be intermediate to some of our pharma products. And mainly they will be pharma intermediates. Will go in pharma intermediates. And some of it might go for the derivatives of those products might also go for animal feed category.
Okay, animal feeds. Okay. And so how much is brownfield and how much is the greenfield?
So major would be the greenfield for the coming year. And only that 40-50 crores which you are earmarking, only that would be the part of that would be used for brownfield.
That of course. Okay. So can you give me some names of the raw materials, like the raw materials that we are using? Like I'm just taking example of the benzene is the one part. What are the raw materials that are using? Can you give me the name of some raw materials?
Yeah, we use a lot of raw material, acetic acid, nitric acid. So many there are almost 300, more than 300 raw materials. Which
major names, sir.
Harit, would you like to answer that?
Actually, we are into antibiotics, so we use a lot of fluorobenzene chemistry intermediates, and also piperazine is one of them. And then a lot of basic chemicals we use, and it depends on the product specific. Basically, many other intermediates we are using. It's very difficult to give names, but there are at least 200 chemicals we are using at least a month. Yeah.
Thank you, sir. That's from my side. Thank you very much.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Ravi Lodha, an individual investor. Please go ahead.
Yes, sir. Good evening, sir. My question is,
your voice is breaking up. May we request you to take the phone off handset, please?
Yes, my question is whether Aarti Drugs is able to get the revenue target of 4,500 in FY26 or 27. Hello.
3, 4, 5, 6. Yeah. So yeah, we should be that is fairly doable.
Okay. Actually, sir, in Concall, that is of Q3 FY21, you told that 4,500 4,500 revenue target will be occur in 5 years, and now you are saying that this target can be achieved in nearly next 5 to 6 years. So whether this target is elongated means it will be delayed.
See, FY26 means that will be now 23, 24, 25 means 3, 4, 5, 6. That is 4 years from now, considering this year.
Okay, 4 to 5 years from now. Okay, sir.
Around 4 years from now, it should be fairly easy.
Okay, sir. And sir, one more question. Your revenue, nearly 43%, it consists of antibiotics. So whether these antibiotics are somewhat import substitution from China?
Partly yes, yeah. Many of them. Yeah.
Yes,
Okay.
Yeah, partly
okay,
yes, because yeah.
And sir, whether we can believe that the margin which we are getting this year, that is nearly 13%, do we believe that in future it can cross more than 20%, or it will be remain 20 to 25%? EBITDA margin?
EBITDA margins, EBITDA margins, once all our greenfield projects come into picture, then definitely we can eye for something near to 20%, and also the regulated markets playing out. Then we can target crossing 20.
Okay. And sir, whatever we are doing the capex, that is of 600 crore. So it will be more margin products or less margin products?
The capex, they are generally higher margin products. Because the thing is, right now, even our existing products are performing, below what they usually perform. So even from the existing basket also, we are hoping for a recovery of around 300 basis points, around 3%. Okay. Even from the existing.
Okay, thank you. All the best from my side, sir. Thank you.
Thank you.
Thank you.
The next question is from the line of Rahul Jha from Bay Capital. Please go ahead.
Yeah, I was looking at again on the R&D slide. So last year you had some 57 MSc graduates and 11 graduates, but this year again it has come down like how much? 1 second. 27 MSc graduates and 28 graduates. So is there attrition happening? Like senior people are leaving on the R&D side, because we are not seeing anything. Gross margins also, like you have been saying that you have been backward integration is happening. So gross margin to EBITDA margin flow should not be weaker, na? It is getting weaker. Your gross margin should expand, or the volume should go up. Nothing is happening in that.
No, I didn't see about the R&D part. I will definitely check all the slides and this, but there is no attrition as such in the R&D.
No, because
in fact,
last year it was 57 MSc graduates. This year 28 MSc graduates. So it is half. And freshers and engineers.
Problem. We'll check the numbers, but then the thing is, on the shop floor level, the ground reality is that we haven't reduced any R&D. In fact, we have put up one more floor in our centralized R&D center at Tarapur. We have expanded the R&D last year, in fact, by one more floor. So the thing is, ground reality is there is no cut down in R&D or anything like that. We are doing R&D. In fact, we have put up pilot plants also last year to do R&D of the bigger projects which are. And your other question was regarding the gross margins, right?
Yes. So like you have been saying regularly that there has been backward integration and debottlenecking and all those.
Yeah.
So based on that,
backward integration.
Yeah. So let me complete.
Backward integration projects are going on. Okay.
So either there should be a gross margin expansion, right, or the EBITDA margin expansion, but neither of it is visible.
Okay. So the backward integration projects which you are putting up, mainly that is happening in the greenfield location at Gujarat. So that facility hasn't commenced yet. Secondly, we, in fact, other backward integration, we had put up the capacity, but the thing is, there is some problem in the pricing parity of few of the very basic chemicals which are available in India and China, and that has also happened because of this situation, geopolitical situation right now, and because of which there is disparity of the basic chemical prices in India and China is where we are facing the heat as of now. But once we come to level playing ground, then from technological standpoint, we are the products, top 15 products in which we are operating. Most of them we are either at par or even better than China. So it is a temporary phase because of which these gross margins and EBITDA margins have been impacted, but that has happened across the board for all the API companies.
Right. Thank you.
Thank you. As there are no further questions from the participant, I now hand the conference over to Mr. Adish Patil for closing comments. Over to you, sir.
Yeah. Thank you. Thank you everyone for joining us on this call. Please reach out to us or our IR consultant SGA. Should you have any further queries, we can now close the call. And thank you once again for participating in this call.
Thank you.
Bye.
Ladies and gentlemen, on behalf of Aarti Drugs Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.